Welcome, everybody, to this 5th edition of the Banking Supervision Forum. It's very lovely to see so many people in the room. It feels like a big reunion. The title of our conference this year is Europe, Banking on Resilience. I'm Conny Lotze from ECB Communications. As you know, this is the last Banking Supervision Forum under the chairmanship of Andrea Enria. So this is also a chance to bid him farewell and hear his insights and learnings over the past 5 years. We hope the forum will offer a good mix of looking back at almost 10 years of European banking supervision, assessing the current state of banking, and discussing the challenges that lie ahead. But without any further ado, let me introduce President Lagarde to officially open the conference. President Lagarde.
Thank you very much, Connie, and good afternoon to all of you. Good afternoon, very especially to you, Andrea, and to all you guests and all you friends. It's amazing to actually see the round of those who care for you, who like you very much, and many of those who have worked with you. So it's a pleasure to welcome all of you to the 5th Forum on Banking Supervision. It was 10 years ago, on October 15th, 2013, that the European Council approved the regulation launching the single supervisory mechanism. It was, in my view, the most significant step in European integration since the introduction of the euro. And there were 2 reasons for taking it. First reason, it would lead to stricter and more uniform supervision, a single supervisor enforcing a single set of rules for a single banking market. That would in turn make it possible to establish a true banking union with a common safety net. And a banking union would strengthen the monetary union by ensuring that bank deposits were seen as equally safe everywhere. To quote Andrea Enria, as he eloquently put it, only unified supervision and an integrated safety net can make sure that €1 has the same value and is afforded the same protection regardless of the member state in which it is deposited. End of quote. Second, single supervision would help make monetary policy more effective, because a weak banking system can complicate our task of stabilizing inflation in both directions. When central banks are easing policy, a fragile financial sector can impede the transmission of lower rates to the economy, especially if banks are unable to lend. And this is what we saw after the euro crisis, when banks were deleveraging as the ECB was cutting rates. But when a central bank tightens policy, weak banks can also interfere with the rate hikes. If monetary policy gives disproportionate weight to financial stability risks, it might tighten less than it ought to. Setting up a single supervisor was a necessary condition to achieve both these goals. But of course, there was no guaranteed success 10 years ago. It had to be tested by time and the turn of events, and it had to be shaped by leadership, notably that of you, Andrea, and indeed your predecessor, Daniel Nui. In my very short remarks today, I will explain how European banking supervision has brought key improvements to the supervisory landscape that we have now, and also to the effectiveness of monetary policy. So, there are many improvements that result from the work that you have done on the supervisory landscape, but I would mention 3 that really stand out. First, European banking supervision has led to sounder banks, thanks to supervisors enforcing tougher regulatory standards and topping them up when necessary. You might not all agree with that, because you might think that those sounder banks have nothing to do with supervision. I would contend that it does. The aggregate common equity tier 1 ratio of supervised banks stood at 15.7% in the second quarter of 23, up by 440 basis points since the start of European supervision. Banks benefit from liquidity coverage and net stable funding ratios well above the minimums, at 158% for the first and 126% for the latter. And non-performing loans fell from around 1 trillion euros in 2014 to below 340 billion at the end of last year. Second, the single supervisor has made supervision more uniform, meaning that supervisory practices are now applied in a consistent basis. For example, single supervision has led to capital add-ons being applied much more consistently across banks. When European supervision began, the correlation between banks' risk profiles and their capital requirements across Europe was just 40%. This meant that for the same risk profile, supervisors in various member states of Europe were applying very different capital requirements. Today, that correlation has risen from 40 to 86%. Third, European supervision has helped us identify common priorities in terms of risk management and address them in a forward-looking basis. Climate risk is a case in point. There is mounting evidence that the costs of delaying are substantially higher than those of a timely transition towards a more sustainable economy. And without a single supervisor, these risks would likely be addressed in an inconsistent way. But thanks to European supervision, banks have been made well aware that failure to take into account the transition would be incompatible with sound risk management. And this is why last year's thematic review required banks to shine a light on climate-related and environmental risks. And it revealed that while banks have made progress, they still have some way to go to properly incorporate these risks into their risk management frameworks. So granted, banking union is not complete. We all know that. But at least we can say that the first pillar, a strong and unified European supervisor, has been achieved and is delivering. So what are the implications of this for our monetary policy? I think we can both say that the last few years, I would say, starting with the pandemic certainly, have tested the interactions between monetary policy and banking supervision in both directions. First, the impact of the pandemic shock required monetary policy to ease significantly in order to prevent a deflationary bust. But unlike in the previous crisis, European supervision was able to leverage the strong position of banks to sustain lending. Supervisors provided capital and operational relief measures to banks. Everybody remembers the ban on dividends. What really was important at that time was the relief measures that were decided. And this enabled banks, not that the other one is unimportant, but this enabled banks to maximize the funds accessible through the ECB's targeted longer-term refinancing operations to channel credit to the economy. And this joint effort was crucial to keep the economy afloat, especially while fiscal measures were still being rolled out. From March to May 2020, bank lending to companies in the euro area surged by nearly 250 billion, the largest jump we have ever seen in a 3-month period. Then we faced a sequence of shocks which pushed inflation in exactly the opposite direction. And that led to the fastest monetary policy tightening in the euro area on record. We ended net asset purchases and increased rates by 450 basis points in little over a year. This is indeed sudden reversal, and it could have severely stressed the European banking sector, just as we saw elsewhere in the world. Indeed, research suggests that the transition from low to higher rates can negatively affect the banking sector. But European supervisors had worked diligently and had done so over the last few years to help banks realign their business models, which enabled them to face the rate reversal on a much more solid footing. In particular, when the ECB began normalizing its monetary policy at the end of 2021, European supervision proactively prepared banks to face the risks arising from the new environment. Supervisors focused on banks' funding strategies and encouraged them to improve their management of interest rate risks. Not everywhere, but here, yes. This included increased scrutiny of risks in banks held to maturity portfolios and disclosure of their unrealized losses, which turned out to be significantly lower than unrealized losses of banks in other places. In this way, European banking supervision has not only empowered our monetary policy response to the pandemic, but also facilitated our fight against inflation by readying banks to the new environment. The conclusion is clear. Single supervision has complemented the single monetary policy, just as theory predicted it would. It was Alexander Pope, the 18th century English poet, who said, "Blessed is he who expects nothing, for he shall never be disappointed." But a decade ago, as we emerged from the euro crisis, we did not have that luxury. We launched European banking supervision with high expectations, not only for it to be a strong supervisor, but an essential piece of a complete monetary union. And it has not disappointed. In fact, faced with severe tests that we could never have imagined at the time, it has exceeded most reasonable expectations. We have a strong banking sector in Europe. It has transformed from a shock propagator into a shock absorber, and under European supervision, banks are now more alert to new risks that may lie around the corner. Is it perfect? No, but much stronger. So, Andrea and everyone at European Banking Supervision, you can look back at a job well done, and I have great confidence that success will continue in the future. And I want to personally thank you for the great cooperation that we've had over the last 4 years. Thank you.